positive operating cash flow of rupees 104 crores pre-Ind AS 116, which was 0.5 crores for the same period last year. This is on account of strong inventory management system combined with continuous inventory rationalization where required. This further aligns the company's commitment to sustainable growth driven by cash flow generation. We are fully committed to improving our operational efficiency and have seen significant progress in managing our working capital. Our working capital cycle has been reduced to 125 days as on December 2023. Specifically, we have reduced our inventory by 29 days from March 23 to December 23, and now it stands at 97 days, which is reflecting the positive operating cash flow generated by the company for the period. Given the current weak demand scenario in the retail industry, the short-term outlook may appear challenging. However, when viewed from a broader long-term perspective, there are encouraging signs and opportunities for growth. While immediate consumer spending might be subdued due to various factors impacting demand, such as changing consumer behavior or slowing discretionary spend, the underlying fundamentals of the retail sector stay strong. The industry resilience and our ability to adapt to evolving market conditions, coupled with investments in technology, product innovation, and positions us well to achieve sustainable growth going forward. With this, I would like to hand over the call to our CFO, Mr. R. Mohan, for an update on the Q3 and 9 months FY24 results and financials. Thank you.
Thank you, Gautam, and good evening, everyone. The company continues to maintain a strong operating performance despite the challenging business environment. First, I would like to give you all financial highlights for Q3FY24. Our revenues for the quarter stood at 202 crores as against 176 crores in Q3FY23, a growth of 15% YOY. Gross profits stood at 124 crores, a growth of 19% YOY, with a GP margin of 61.5% for the quarter. Our EBITDA for the quarter stood at 68 crores as compared to the 60 crores in Q3FY23, a growth of 13% YOY. Our EBITDA margin stood at 33.4%. Profit after tax for the quarter stood at 23 crores, a degrowth of 4% YOY. PAT margin stood at 11.6%. Coming to the 9 months FY24 performance, revenue stood at 581 crores in 9 months FY24 as against 504 crores in 9 months FY23, a growth of 15% YOY. Gross profit stood at 355 crores, a growth of 17% year-on-year, with a GP margin of 61.2% for the 9 months ended. EBITDA for 9 months FY24 stood at rupees 189 crores as compared to rupees 163 crores in 9 months FY23, a growth of 16% year-on-year. Our EBITDA margin stood at 32.4%. PAT for 9 months FY24 stood at 70 crores as compared to 68 crores in 9 months FY23, a growth of 3% YOY. PAT margin stood at 12%. Our advertisement spends during 9 months FY24 stands at 1.94% of the revenue. ROCE and ROE on an annualized basis stand at 15.5% and 16.7% respectively. Cash and cash equivalents stood at rupees 197.2 crores as on 31st December 2023. With this, we will now open the floor for the question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yes, sir. Hi. Thanks for the opportunity and congratulations on a very good working capital optimization. Sir, first question is on ASP. For H1, we did see very good ASP growth, but Q3 ASP sort of indicates that it is largely flat. So what is the reason for this, and are we also sort of seeing lower items per bill in case this is a downtrading phenomena because of weak consumer sentiment?
Yeah. Hi, Devanshu. Thanks for the question. See, this ASP being flat compared to Q3 last year is largely because of two reasons. One is product mix. This time the slightly lower value products are sold a lot more in terms from a product mix perspective. And the second smaller reason is that this time we have run some festive bill level promotions in November and December, in half of November and 2 weeks of December. So these are the two main reasons why the ASP has remained flat. The larger reason is that the product mix has because of the product mix. This time slightly the lower ASP product is sold a little more than the higher ASP. That's why the ASP on a YOY basis for Q3 has remained flat.
Got it. And any comment on items per bill, sir? I mean, what is the trend there?
Fairly similar. No change on that.
Fairly similar. Okay. Second question is on this 12 to 13% SCSG that we have reported for Q3 and 9 months. So how should we see this growth number? Is this like indicative of market share gains in those particular clusters, or the market itself is growing at 12-13% as per your assessment?
No, I mean, look, it's very difficult to know at what speed the market is growing. It's because we've always had the cluster-based expansion model in our real estate business development. This is just an attribute to we adding more stores in our existing clusters and strengthening our business. So it's very difficult to compare with what those clusters market rate is growing at. We don't have that data. But this is just strengthening to our, this basically attributes to our expansion, strengthening in clusters.
Got it, sir. On gross margin front, Gautam, last year there was some higher sharing of discounts also with LFS partners, which Go Fashion sort of called out. In my view, that should also have resulted in about 200 bits of benefit on that account itself. Can you explain as in whether we have started to realize the benefit of low-cost inventory, or that is still yet to come in our?
No, so very, very rightly you pointed out, Devanshu. In Q3, we had such provisions in our LFS revenue, which you rightly pointed out, last year, same quarter. So this year, I would attribute 1%, 100 bits increase because of cotton prices.
Okay.
So I think we've reported 170 bits of increase in gross margin, if I'm not wrong.
200.
That about, sorry? 200 basis points. Yeah, so out of the 200 basis points, about 1% would be pertaining to cotton prices.
Got it. And lastly, if you could also explain the seasonality of gross margin for your EBOs, not for the entire business. Just for your EBOs, as in between quarters, how the trend pans out between Q1, Q2, Q3, Q4?
Usually Q1, Q3 and Q4 will be similar. Q2 is the highest because Q2 is usually when the EOSS period happens. So I would say Q1, Q3, Q4 would be similar. Q2 is when slight dip in gross margin happens.
Slight dip in gross margin. Got it, sir.
Slight dip in gross margin because that is the EOSS window.
Yes, sir. Got it. Thank you, Gautam. Thanks for taking my question.
Thank you very much.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, good evening, and thanks for taking my question. I have two. So firstly, I noticed that in the opening remarks you mentioned that store opening guidance for this year is 100 to 110 stores, and we have always mentioned this to be 120 to 130. So there is a dip there. So going forward also, you had earlier guided for a 150 to 160 store additions. So is there any recalibration there, or there it is still the same? And just a clarification, if this number pertains to gross additions or net additions, that would be helpful.
Sure. Thank you, Sameer. So Sameer, all our guidance as far as new stores are always net additions. That's what we guide. So we usually guide, very rightly you pointed out, we guide between 120 to 130. Actually, what has happened this year, we've had 13 closures. And because we've had 13 store closures, our net additions have fallen. So that's why instead of achieving 120 stores, we will be slightly lower is because of store closures. Now, these 13 closures, what these 13 closures are, these 13 stores are historical stores which did not recover post-COVID. And they were breaking even for the longest time. Last couple of quarters, we noticed that these stores have become negative, and that's why we've taken a call. So this is more like a one-off item which has happened. So that's why our net additions are a little lower because of the 13 store closures. As far as next year is concerned, we are looking to adding about 150 stores net addition. We're keeping that guidance good because we feel from next year onwards demand should pick up, and we would be keeping that expectation of adding 150 net addition.
Great, that is helpful. Secondly, just a ballpark calculation on pre-Ind AS EBITDA suggests that we've largely maintained it around 19.5% this quarter versus similar last year. And with a flattish SSSG and the gross margin benefit being taken away by increase in ad spends, I'm just wondering why there is no negative operating leverage coming in. In fact, if I do a ballpark calculation on the fixed rental per store, it has actually declined by 5%. So, I mean, these are ballpark numbers. So, I mean, but still you get the point, right?
Yeah, Sunny, but actually there is a fall in pre-Ind AS EBITDA. So last year in Q3 we had a pre-Ind AS EBITDA of 22%, and this year we have a pre-Ind AS EBITDA of 19.7%.
Okay. Maybe my calculation on that last year is wrong.
There is a fall. Basically, this fall is largely because of the higher salary and rent cost because of flat SSSG. This fall in operating margin from 22% to 19.7% is because of higher salaries and rent cost.
Oh, okay. Got it, sir. That's all from me. Thanks. I'll come back in the case I have any follow-up.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
Sir, first question is on the inventory. Commendable job on inventory in the peak season. Just want to know, is this sub 100 days now sustainable going ahead, or given the festive, the buying was low, and as we enter Q4, we will see some increase of inventory build up there?
So Ankit, this is pretty much sustainable. So right now, currently we are on 97 days based on 9 months average sale. On the March number also, I think we will be similar. So I think over a period of time, this 97 days should stabilize at around maybe about 88 or 90 days. In March ending, we might hold some higher inventory because for summer season we introduced some styles. So we might hold slightly higher inventory, but it shouldn't make the inventory days go up dramatically.
And this reduction in inventory, if I look at the store front, we are not seeing reduction at the store level inventory. This is purely from the warehouse inventory where the reduction has come in. So from a cover perspective, what has been done at the warehouse level by you in terms of pure RM and finished goods inventory?
No, see, we were, if you look at my March numbers, we were actually having a lot of high inventory at the warehouse level as far as finished goods and RM is concerned. So we have reduced, our FG at the warehouse in March was around 99.9 crores, which we reduced to 71.7 crores in December. Our RM inventory also has slightly come down from 43.5 crores to 35 crores. We basically fine-tuned the base stock or the appropriate stock levels in our ERP. And once we do that, once we change the ratios in our stock management ERP, it automatically starts showing in the numbers. So it's just a result of we bringing down the stock levels. We felt that we don't have to have that kind of high inventory. So gradually over a period of 2-3 quarters, it has shown us results and tapered down.
Sure. My second question is on the rental part. We are opening bigger stores and the revenue per store or the throughput continues to be the same or slightly lower given the subdued environment we are in. Are you looking at opening smaller sizes, or you think that 500 square feet size is the base and incrementally throughput, might remain at that 19,000-20,000 sales per square feet, or we might see an increase there as well as the bigger stores inventory is more better at the store level?
Sure. So Ankit, this is a good question. I'll just take a minute to explain it. See, Ankit, whenever we are opening any type of store, for us, size is an important ratio, but what we really budget is what is our rent to revenue ratio. If I get the perfect location in the market, even and if the rent is in my budget of say 13% or 15% to revenue ratio, then I might even take a bigger store or even a smaller store. For me, my prime of focus selection of our outlet is based on the location itself rather than the size. So moving forward, if we get the right location, we might even open a 600, 700 square feet. We might even open a 200, 300 square feet. It is all on the basis of location selection. Now what happens is, between a 600, 700 and 200, 300 square feet, rental is anyway budgeted. The capex is not very different between the two formats. And even your operating costs, like your employee costs also, you might have only those 3-4 people in a 600, 700 square feet versus a 200, 300 square feet. So your dynamics between a slightly larger store or smaller store does not change unless your rental changes. Now, coming to sales per square feet, I've also guided in the past that we actually as a company don't look at sales per square feet because of this very reason. Because we go by rent to sales ratio and not by square feet, we always look at absolute averages of a store and what kind of EBITDA percentage it throws rather than looking at SPF.
Fair point. Now, my third question is on the promotion in the quarter. I noticed for the first time since listing, higher bill sizes, we are offering some vouchers to the consumers for the next purchases, and that's indirect discounting, right? So from that perspective, are you really seeing that kind of a slowdown in the market? You had to call out the offers to the consumer, or this is a regular affair in the past as well?
This is a we've done it for almost 4-5 years. See what happens basically during festive season to increase the ATV and the bill basket. We give out certain redeemable vouchers on a particular bill value. Now, what happens is, suppose you're giving out, say, 1,000 vouchers or say 100 vouchers. Your conversion of these vouchers in terms of redemption are less than 15%. So, because the redemption has always been low, we've always carried this process of giving vouchers and making the primary bill a higher value bill. And this we've always done for the last 4-5 years. In fact, we've been doing it since pre-COVID. This is a very festive arrangement we do. This is not from a inventory liquidation perspective. This is purely just to uptick the bill value.
Sure. And lastly, on the pledges, we are less than 1 month away from your guidance of March end. Is there any update for the pledges reversal?
Yeah, I'll give an update. See, we had planned for March, but unfortunately, it will get delayed by a few more months. I would like to reassure everyone that the pledge is absolutely safe and things are going in the right positive direction. We are just delayed by a few months, but it will close soon. It is working in the positive direction. As far as promoters are concerned, it is on top of our priority list, and this will close for sure. And I would like to reassure everyone this is absolutely safe. There's no problem in that.
Gautam, on the pledges part, can we see any directional improvement like small pledges getting reversed and then, we see, or you think it's going to be a bullet reversal where 100% reversal will happen at once?
No. When the clearance will start, Ankit, it will clear in that way. So, initially, one part of the pledge will get over, then the second part. So within that few months, most of the pledge should get over. That's how what you said is absolutely right. It will get in one certain percentage will get released first, then the second. It goes in that manner.
Understood. Thank you so much, Gautam.
Thank you, Ankit.
Thank you. The next question is from the line of Sabyasachi Mukherjee from Bajaj Finserv AMC. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is, on the SSG volume, my calculation suggests that since ASP has been relatively flat and we reported a SSG value of, flattish, the volume decline has been arrested. Is that a fair understanding?
Yes, Sabyasachi. The understanding is clear. The volume SSG in quarter 3 is flat. It is a zero. So it was about -5 or 6% in Q2, and it has improved to 0% in Q3.
Right. So going forward, I mean, how do you kind of look at it in terms of footfalls, or let's say, are we confident enough to say, let's say, this is the bottom, or Q4 maybe there might be again a decline in the volume front?
See, right now it's a little hard to say. We will get an understanding of Q4 probably after February 15th. Usually, midway point is when we have a full understanding of how the quarter is. So it's a little difficult to suggest. But I am expecting at a value level, at a company overall value level, a mid-teens type of growth in Q4.
Sorry, this mid-teens level of growth you are saying on the revenue?
At the overall level, on the revenue overall level.
Okay.
This part is a little too early to comment because we probably will get a better idea of SSSG for Q4 when we are at the halfway stage. After 15th February is when we'll get a better clarity.
Got it. Follow-up to that is on the FY24 revenue guidance of 800 crores. Still intact, or are we kind of revising that?
No, it is. We won't be able to achieve 800 for sure because for the first 9 months we have done a 581 crore number, and we are expecting a mid-teen type of number in Q4. So unfortunately, we've not been able to hit the 800 crore this year.
Okay. Got it. Next question is on the inventory. Can you please provide the breakup between the RM and FG and in FG between warehouse and store?
Sure. Our RM inventory as on December 31st is 35.68 crores. Our FG at warehouse is at about 71.7 crores. And our FG at stores is at about 98.44 crores. So our total inventory is 205.84 crores versus 230 crores in March.
Got it. And so follow-up to this is the kind of inventory reduction that we saw in the warehouse level since March 23. Is it purely because of the lower cotton cost and hence the total inventory gets revalued at a lower cost, or there is also an element of lower number of items sitting in the warehouse as well?
No, this is not because of cotton prices. See, we've actually not been purchasing literally anything. That's why in our gross margin we have not seen that kind of uptick in our GM. This inventory reduction is purely on the basis of optimizing sourcing and buying.
Okay. Got it. Lastly, on the A&P expenses, I believe this quarter you have spent little higher than I think probably what you have guided in last call. What would be the target for full year? 1.5% I think was the last communication from your side. This quarter we have spent little higher.
So for the 9 months we are at about 1.9% of revenue. So it will be in similar lines by March. It will be around 1.9. It will be under 2%.
And any guidance for next year? You're looking at similar 2% number?
Right now we haven't budgeted for next year. Maybe closer to March is when we're going to be budgeting the ad spend for next year.
Got it. Thanks.
But more or less it will be in the similar range only. I don't see it changing too much, frankly. It will be in the range of 2% only.
Sure. Thanks, Gautam. That's all.
Yeah, sure. Most welcome. Yeah. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Prerna Jhunjhunwala from Elara Capital. Please go ahead.
Thank you for the opportunity. Just wanted to understand your opening remark statement wherein you mentioned that you are exploring omni-channel opportunities. So if you could just help us elaborate on that.
Yeah, see, what we've been doing for the last year or two, a little longer, is that how we are able to convert an offline customer to online sales. Because in retail, what happens is when you're running such a compact size store, sometimes on a weekend it becomes very difficult for the customer to get the entire set of colors or sizes. So there we are trying to see if we are able to convert that offline customer to online, and then immediately, by using a online tab at the store, place the order for the customer and get it home delivered. So in certain stores we implemented it and we are seeing some success. So it's taking some time for us to scale it. But this kind of omni omni-channel approach is seeing us, not lose weekend sales in certain stores.
Okay. And how does this help you in terms of getting revenue? I'm just trying to understand the impact of this in the stores that you have implemented already.
See, we have seen in some stores where this is a success, we have seen an increase of 1% or 1.5% in sales of that particular store. And we feel that, if the trend and the trend of omni picks up, then maybe over a longer period of time, this can be a good addition or contributor to the store's revenue. Because at the end of the day, no store can vouch saying that there are no loss of sales, because on a weekend, all colors and sizes might not be available. So if we are able to convert some into online, it can be a contributor to the revenue. Very difficult to say how much. I think once we implement on a more larger sample size of stores, we know how much it can contribute as a percentage.
Okay. Second question is on LFS strategy. Going forward also, do we see the same kind of expansion in LFS of around 250, 300 odd stores across Tier 2, Tier 3, Tier 1 cities? And also, if you could help us understand the demand in the various type of cities, which could help us understand the demand scenario in a better manner.
Sure, Prerna. So, Prerna, see, usually on a steady-state basis, we always guide that the number of LFS stores we are going to be adding will be about 100 to 150 LFS stores. So, I think for next year also, we are guiding about 100 to 150 doors. As far as demand is concerned, our presence is largely in the metro cities, and like 60 to 65% of our entire network is in the top 8 or top 10 cities. So from that perspective, demand in the metro cities has been weak, and the same trend has been seen in the Tier 2 cities as well. We've not seen either has been an outlier.
Okay. Thank you so much.
Thank you very much. Yeah.
Thank you. The next question is from the line of Priyank Chheda from Vallum Capital. Please go ahead.
Hi. So my question is, if I have to refer to 9-month trend, where our PBT growth is just 4%, SSG is 0, and cluster growth is 13%. What does this imply? These 3 data points, if I have to put it together, is that the new stores that have been added into the cluster have not added meaningfully to the sales, while customers in that same cluster are buying, and hence your cluster growth is 13%. So then why should we add new stores into the same cluster, load the cost in the cluster, and rather go on a national expansion? So just a thought around it would be helpful.
See, also Priyank, what happens, why do we expand in clusters? Because shopping in a city happens in clusters. See, you understand, like for example, now in Chennai, there is an area called Pondi Bazaar, which is in T Nagar. Now, Pondi Bazaar as a market caters to different parts of Chennai. Now, for example, if there's Jayanagar in Bangalore, Jayanagar as an area will cater to different parts of Bangalore. If I don't grow in the same cluster, I won't be able to grow my revenue, because shopping does not happen by residential locality, it happens by shopping cluster. So in general in retail, if you have to continue growing your size and footprint, you have to keep growing in cluster. Now, coming to the point on operational efficiency, because SSG has been flat and the new stores what we've added in this particular 9 months, when SSG is flat, even your newer stores what you add will tend to underperform than the regular new store average. Because of that, we've had an operational reduction in margin.
No, so what I'm trying to understand is a new store in a Pondi Bazaar should also grow if that cluster is growing. Is what I'm not able to understand, because if that new store is going to add a shopping experience or is going to add or is going to save the logistics cost for a customer to travel 2 kilometers to buy a 700 article, so it means that new stores should meaningfully also grow in that cluster, is what I'm trying to understand.
Yeah, so that one store, obviously the addition has happened. The one store stays sales have been added to the overall revenue, but whereas the other stores have not grown in this weak environment. So the question is, if I would not have added the store, would my SSG be positive? The answer is no. Because when we are adding another store in the same cluster, we are mindful of the cannibalization part. Wherever we feel the stores are going to get deeply cannibalized, we don't add another store in that cluster. So it's basically trying to attract higher market share of that particular cluster by opening another store.
Got it. And on the inventory side, so our key moat is to keep the number of colors, sizes available, so that whenever customer comes, customer doesn't get the articles are available in our store. So when we are rationalizing the inventory at the store, are we not compromising on the sizes, colors that Go Colors is known for it?
No. So Priyank, see, earlier I had actually answered this question. See, when we had got into the optimization mode for inventory, we were very clear that we wanted to optimize inventory at the warehouse front. So what has changed from March till now is inventory has got optimized only at the warehouse. The store front, the same inventory carries forward.
Yeah, I understand. So what I'm trying to ask is, the article may be available at the warehouse, so a green color for a L size would be sold. So once that is sold at the store, would get easily replenished from the warehouse. In that case, in case the green color is not available at the warehouse, wouldn't it affect the sales for that particular article?
No, I understand what you're saying. So basically, we have not optimized it to that extent that there is loss of dispatch from the warehouse to the store. See, when we have optimized it, we have kept in mind what is going to be our throughput in our stores and how much is going to be needed for us to dispatch from the warehouse to store. Keeping that in mind, we had optimized it. So we have not over-optimized it as well, see, where we have loss of sales or loss of dispatch.
Got it. And what would be the number of stores that would be falling into the cluster SSG calculations now in Q3?
It will be around 425, about 430, 432 stores.
Last quarter it was around 450. So would it remain same?
That might be. Then maybe what number I'm giving right now is wrong. I'll have to just check and come back to you on this.
On an average, in case we are adding 25 stores, the similar way 25 stores would also get added to the cluster with whatever the base number that we have.
Not necessary, because when we are adding X number of stores a year, some might be new cities as well, and some might not be in clusters as well. It's not that our entire store count what we are adding are in clusters. That's not true. But anyway, this of how many stores across how many clusters, I'm not having it handy. I'll share it offline through SU.
No problem. All right. Thank you.
Thank you, Priyank.
Thank you. The next question is from the line of Nilesh Shah from Julius Baer. Please go ahead.
Yes, hi. Are you able to hear me?
Yes, Mr. Nilesh. Please go ahead.
Hi. Yes. So just a qualitative comment, right? I would like to understand from the management team, right? Basis the numbers that you have put out thus far, what is giving you confidence that you are not losing market share, right? And I'm asking this specifically because, there are, multi-product companies, right? Some retailers, some brands, right? Where, at least there is some indication that they are able to succeed both on their, offline stores and also online to an extent, right? So and I understand data is hard to get, right? But I do recall in the past that you used to maintain some information by capturing, the mobile number of your customers. And so have you seen any drop in frequency of your loyal customers, right? And that's something perhaps you can quantitatively answer, but qualitatively, if you can also give further color, what is giving you confidence that you're not losing market share? Thank you. In the bottom wear category itself. Thanks. You can go on.
Yeah. So let's see. One of the biggest confidence points is that even in a tough environment like we are in for apparel retail, our overall company growth has been about 15%. We have seen volume growth at an overall company level. We've not seen volume degrowth in quarter three. So where the industry has been going through a struggle, we have done performed decently well, especially in our vintage markets. So keeping these points in mind, and look, we keep interacting with our customers. Our most vintage customers also keep coming back to the store to understand what's new, what new color has come out, what new product is doing. So from a bottom wear perspective, we are very much relevant because from a product portfolio we are really involved. Nowadays, we in quarter one we had also come out with a jeans product. Over a period of time, we introduce new colors in the other bottom wear products as well. So from a product perspective, we are very fresh with the customers we are dealing with. So these few things gives us confidence that we are heading in the right direction and not losing market share.
Okay. Yeah. No, so look, I
voice is breaking a bit.
Hello.
Yes, now you're audible.
I think the only sort of area where I would probe further is to ask that essentially for your customer, right? If we believe that they are buying a bottom wear after having purchased a top wear product elsewhere, right? Then for that transaction, right, you have to basically believe that you will do for you to sustain your market share and position in the minds of your customers, right? Are you seeing that in micro markets where you operate, do you believe that your revenue growth in those clusters, right, are keeping pace with the revenue growth of, say, the larger peers who operate there, right? Because also bear in mind, a number of them players have also become very large on the online segment, right, which you may not be able to capture in your local intelligence.
So Nilesh, see, I understand where you're coming from. See, largely bottom wear category is more of an offline category because colors need to be matched. On an online platform, for you to match so many colors becomes physically very difficult. It's not possible. So this is more of an offline category. Secondly, why we feel we are currently relevant in today's times as we are evolving also as retail is because the lady's buying behavior is that she wants to buy the top separately and the bottom separately. See, what happens in a top wear store, because their focus area is top wear, they're unable to keep the range of bottoms what a dedicated bottom wear store would be able to keep. And that is why today a lady is choosing to buy the top from the top wear store and the bottom from the bottom wear store. And one of the reasons why we feel we are not losing market share right now is because in terms of competition, we don't see too much of competition elsewhere, everywhere. We are seeing competition coming up, but right now it's not made a very big dent, or it's not made a dent at all in our market share.
So that is where I am challenging your lens, right? I think perhaps one of the lens that you're using is, are there other bottom wear brands like 11 or something, and are they doing better than you? But what I am asking is, let's say a company, an in-house brand of, say, SI, right? If they are selling a consolidated product, a top wear plus bottom wear, are you losing market share to that? That's the question. I know that you are doing very well versus an 11 and all that, but are you losing share to a consolidated product that a customer is choosing to pick up?
So Nilesh, I'll explain. This is a very good question. So Nilesh, what happens is, an LFS competes with another LFS. a private label of an LFS like a website you mentioned, they will compete with another private label of another LFS. A vanilla brand like us will compete with another vanilla brand. That's why in the mall today, from variety of retail, you have a large format stores and you have multiple vanilla stores. A vanilla store and a vanilla brand will never compete with an LFS, and I'll tell you why. Conceptually, an LFS is a type of retail store where they have multiple different categories without going deep in any one category. So customer who's entering an LFS is entering in a very different mindset. Whereas a vanilla brand like us or a Topwear brand will go deep in that one category and keep more options. So a lady who's buying at a Go Colors is also buying at an LFS. It's just that her buying behavior is different between them. So it's an apples. So I would say, to put it in better words, it's an apples to oranges comparison between an LFS and a vanilla brand.
I see. Okay, great. I think, thanks for that. We will get in touch with you.
I connect with you offline on this.
Yeah. Thank you.
Thank you, Nilesh. Yeah.
Thank you. The next question is from the line of Vaishnavi Mandania from Anand Rathi. Please go ahead.
Yeah, hi. Thanks for taking my question. I'm sorry if I missed this, but there's been a very sharp absolute increase in our employee expenses and other expenses line items this quarter. And the ad expenses don't seem to be much significantly higher. And the increase is far higher than the network addition also that we've seen in the EBO stores. So what is the reason for the same?
So Vaishnavi, on the employee cost front, the employee cost sharp increase is because we've added new stores. So this is largely front-end employees. If I take our back-end, head office and warehousing employee cost, there's no much change in that. Apart from the increments we have given, but there's no much change in that. So this is largely increased from a front-end perspective, which is EBO and LFS. On the other expenses line item, I think if I'm not wrong, there is a 4.7 crore increase in other expenses between Q3 this year and Q3 last year. So this is largely advertising spends of about 2 crores. And another 50-60 lakhs was pertaining to stores which we have closed and taken a write-off in the period.
Okay, got it.
So roughly out of the 4.7 crores, 3 crores would be pertaining to ad spends, and the few stores which we have closed, we have taken a write-off in the other expenses cost.
Okay, understood. Okay, thank you so much.
Thank you, Vaishnavi.
Thank you. The next question is from the line of Binoy from Sunidhi Securities and Finance Limited. Please go ahead.
Yeah, hi Gautam. Thank you for the opportunity to ask questions. A few data points. I couldn't get you said pre-Ind AS EBITDA margin for Q3 FY24 was 19.7%. Am I correct?
Correct. Yes, correct.
Versus 22% in Q3 F23.
Last year Q3, correct.
Understood. Okay. Now, and also could you help me with the rental expense for Q3 F24?
Sure. The rental cost before Ind AS, our rental cost is for Q3 is 30.1 crores.
30 point.
For Q3.
Okay. Sure.
This is non-Ind AS. Ind AS rent paid.
Pre-Ind AS total rent, right?
Yeah, total rent paid pre-Ind AS is 30.1 crores.
Understood. Fair enough. Gautam, you said earlier in your remarks, you said that the gross margin season-wise, so Q1, Q3 and Q4 is somewhat similar, while Q2 the gross margin is slightly lower due to EOSS, right?
Correct.
I was just wondering that even Q4 gross margin should be somewhat similar to Q2 because of the EOSS?
Will be, but it will be somewhere in between Q2 and a regular quarter. The highest impact on the gross margin usually comes in Q2. It comes in Q4 as well, very rightly you pointed, but the impact from a trajectory perspective is more in Q2.
Understood. Okay. Another question was on the SSG growth that we've clocked, somewhere flattish range for the 9 months, right? And targets are slightly negative. I understand that there has been, consumer spending slowdown and there has been a little weak macros. However, if you look at your company's trajectory pre-COVID, right, we used to do SSGs well above 10%. So I was just wondering, in this 4 years, also what has happened is that there has been a proliferation of national players. So would you say that the softness in the SSG is also because of heightened competition from national players?
No, I wouldn't say a competition from national players. See, our pre-COVID SSG was in high double digits. In fact, we were guiding and estimating an SSG at a value level of about 8 to 10%. From that high double digit, I came down to 8 to 10% because we've also added more number of our own stores in our own cluster. So sometimes we become our biggest competition to our existing stores. Having said that, when we are adding stores in a cluster, we do it from a mindset of non-cannibalization. So this 8 to 10% SSG is what usually we guide. But unfortunately, the overall retail scenario has been a little muted. So this SSG has taken a hit.
Fair. Okay. Another question I wanted to understand on your price architecture, right, that you have, and you've maintained that. Obviously, you've taken a little bit of pricing to offset the commodity inflation, but by and large, you've maintained the price architecture roughly about 250 to 1600 rupees, and 80+% of your products are below 1050 rupees, if I'm not mistaken.
Correct. Yeah.
So, do you feel that, having said this, most of your products are actually upwards of 500-600 rupees, priced upwards of 500-600 rupees, right? So, having said this, do you feel there is a need to maybe introduce certain products at a very low price points which can recruit additional customers into your fold?
Well, I don't think that's needed because the kind of customer segment we are targeting. Hello, am I audible?
Yes.
Yeah, sorry. So I'm saying the kind of customer segment we are targeting, an ASP of 700 to 800 rupees is very, very, very competitively priced. So I don't think we have to lower our pricing to lure more customers. It's not needed. In fact, we are looking to increase our ASP and take it as closer to 1000 as possible. We feel that the mid-level customer and the premium customers, that ASP will be well suited for those two income segments without their problem.
Understood. Okay. Could you help me with the volume growth for Q3? The overall volume growth, not the same store sales volume growth.
Sure. I'll just tell it in a minute. Just give me a second. It would be, I think it would be around 10%. 1 second, I tell you. Overall volume will be about 6%.
Sorry, 6%?
6% for 9 months overall volume.
No. Could you help me for Q3?
For Q3, just give me a second, it's 7.6%.
7.6. Okay. And my last question, Gautam, just a small clarification. So while giving inventory breakup, you said the RM inventory was 35.6 crores, whereas FG inventory was 71.7 crores, and store FG inventory was how much?
98.44 crores.
98.44 crores. Okay. So are you actually kind of reducing the inventory at a store level?
No, not at a store level. The optimization, what has happened is actually happened at the warehouse and at the warehouse level at a FG and RM level, not at the store.
Okay. That's all from my side. Thank you so much.
Yeah, sure. Thank you.
Thank you. The next question is from the line of Gautam Rathi from CWC. Please go ahead.
Hey, hi Gautam. Thanks for taking my question. Just two questions. One, a clarification. So in one of the earlier questions, you said that due to store closures, you had an impact of about 3 crores. Is that number right? What I heard, 3 crore, or is it?
No. The 3 crores, in the 3 crores, 2 crores is relating to action.
Okay, 2 crores. So 1 crore is the net one-time impact.
Slightly lower than 1 crore. Exact number I'm not having handy. My understanding is 60 to 70 lakhs would be regarding to store closures.
Okay, got it. And the second thing, so we have been, the floods in Chennai and all. Did we see an impact since we have a larger presence there, like some kind of impact? Which is
when it happened, one weekend got spoiled for Tamil Nadu as retail, because see, the flood situation in Chennai was bad, but even the other parts of Tamil Nadu retail got impacted. So I think in the overall scheme of things, I think we lost a weekend sale. One weekend sale in Tamil Nadu.
And Tamil Nadu would be what proportion of your revenue roughly?
Would be about 20% of my revenue.
20% of your revenue lost the weekend. That's how it is.
Yeah, one weekend. Yeah, yes, absolutely.
Gaurav, just one more question. Just wanted to understand. You also mentioned that you are at an ASP of 750, and you are aspiring to eventually move towards the 1,000 rupee ASP mark, right? Going with your customers. So, just also wanted to understand, do you also have a plan to go, at the lower? You don't want to target the entry level customer, or do you think for you this is the best way to scale, right? I'm just trying to understand, for your 20% growth, is this the way you're thinking about it, or could your growth be faster if you also look at it differently, right?
No. See, I think lowering the pricing will definitely not help, because the kind of customers we are dealing with, we have, for example, our legging is a 599 product. And if an entry level product of a much lower quality garment would be 399. The customer who's buying the 399 entry legging of a low quality will also buy my 599 legging. So I don't have to really decrease my prices to generate more volume. It's not going to increase the volume in any way. So for us, we feel the kind of customers we are dealing between the mid-level and the premium, the 750 to 1,000 is a very good ASP to be part of. See, anywhere when we are crossing 1,000, then we are moving away from the mid-level. That carries a risk, which you rightly pointed out. Okay, so between 750 and 1,000 is a very good sweet spot.
Perfect. Actually, I just wanted to refine my question better so that I am able to kind of put it across properly.
No, the idea is very clear that we want to increase our ASP slowly up to 1,000, not cross 1,000 though, but take it up to 1,000.
Perfect. The question I have is, you have a 599 entry product today, which is your entry point, right? And I'm not saying go down on the quality strata or whatever, but is it possible, or in your mind you are not looking at let's say another giving the 399 rupee customer a better option?
No, we will not be looking at that.
So we are looking at 599, and we are waiting for the customer to come up to that strata. That is our approach right now today, right? Is that okay?